Welcome back. I'm Leela Rao, your host for Invest Wisely, your ultimate gateway to prudent investing. Before the global markets collapsed and the world economies went into a severe recession, most of you were feeling very comfortable about your financial situation. Stock markets and property market around the world were soaring at all-time highs. Banks were lending with minimal paperwork even to low credit score holders. Unemployment was pretty low and people thought they had stable jobs or businesses. The world seemed perfectly investor friendly and nothing appeared risky. DIY investing or people managing their own money thought they had diversified by investing in different stock ticker symbols they were familiar with or something they heard from their friends or colleagues. And others who engaged poorly qualified advisors or advisors with vested interests had their portfolios invested in mutual funds that had different names but similar strategies. Many who had burned their fingers with reckless investing in stock market previously decided to put all their money in real estate. This led investors to concentrate their wealth into only one or two asset classes, leading to higher risks than they can tolerate. When top investment houses like Lehman and Bear Stearns went bankrupt, sending the world markets to collapse, the losses in these poorly built portfolios were very substantial, and many even lost a big chunk of their hard-earned principal. Remember, we are just attempting to get out of this global recession, but we still have several hurdles like a record unemployment rate, a mountain of national deficit, and still never-ending stream of foreclosures in the housing market, so on and so forth. Well, we can go on with this depressing list, but trust me, my motive is not to frighten you or disparate you, but steer you towards disciplined investment practices. During recessionary or post-recessionary economy, nothing but proper asset allocation can actually prevent you from again going through severe losses and emotional shock many investors had suffered not too long ago. Now let's see in simple words what asset allocation means. Tell me, can you get cured by taking your neighbor's medicine? Of course not. You need your specific prescription for your specific illness. Asset allocation is that specific medicine for you as an investor that is the starting point in building a customized portfolio. It is a technique that balances risks and creates diversification by dividing your money among major asset classes like cash, bonds, stocks, real estate, commodities, etc. Before we go further, I want to introduce here two terms. One is human capital and the other is financial capital. Human capital is actually the present value of all your future earnings. The value of your human capital is higher depending upon the skills and education you have obtained. Financial capital, as you all guessed, is nothing but your wealth in monetary terms. Normally, when you're younger, your human capital is higher and your financial capital is lower. The trend reverses gradually as you get older. In order to cleverly allocate your assets among various investment classes, you must not only consider your investment goals, but also your risk profile, your time horizon, your tax situation, and any legal or unique constraints you may have. The human capital you possess is often ignored in this equation, but actually, this plays a vital role in determining all the other factors I mentioned earlier. Finally, financial market and economic expectations are taken into account in coming up with the right asset allocation for your portfolio. Now, each asset class has different levels of risk and return, so each will behave differently over time and also during different economic situations. For instance, while one asset class like stocks increases in value, another asset class like bond may decrease or not appreciate as much in some economic situations. It is not just the allocation to different asset classes like stocks, bonds, real estate, etc., that gives investors the best protection, but also allocation within each of these asset class that provides superior protection against major losses. For example, let's take stocks for instance. Stocks are further divided into several sectors such as technology, financials, healthcare, energy, so on and so forth. And these sectors are further divided into subsectors, like if you take technology for instance, it is further divided into subsectors like semiconductors, computer software, hardware, etc., etc. Same is the case with all the other asset classes like bonds, real estate, commodities, all these asset classes. Each subsector behaves differently in different economic scenarios, and before you choose them for your portfolio, you need to analyze the underlying fundamentals with reference to your risk profile. Investing just in the stocks, bonds, and other asset classes in one country is not a very intelligent investment decision. You reduce risk by allocating assets to different geographical regions, not just in developed markets like the US, UK, Canada, etc., but also an agreeable proportion in some of the fast growing emerging markets like India, China, Brazil, or South Korea. This way, you will not suffer a major loss when the economy of one country goes down badly. You will be compensated in another region where the economy is booming. Let me tell you this, when the developed nations had suffered the worst crisis in history due to subprime problems, banks in Brazil and India and other developing countries were shielded and did not suffer so badly. Now wait a minute. That does not mean that you must run and allocate all your assets to India or Brazil, but choose the right percentage that fits your risk tolerance. A word of caution here for you when it comes to risk. Lots of people say I am aggressive and I am willing to take lots of risk to make money. Here you need to step back a little and see if you have the ability to do so. Ability does not mean just your earning capacity. Several other factors dictate it. You may be getting closer to retirement, or you may have kids going to college or professional schools, or you may be sending a regular check every month to support an ailing old relative. Well, the list is exhaustive. A well-qualified investment or portfolio manager will take into consideration all the factors that govern your risk profile and return requirements and come up with the correct long-term strategic asset allocation for you. He or she will also be able to rebalance when needed and tactically allocate your assets from time to time to make use of opportunities or threats in the market to protect and also appreciate your portfolio. Coming up next is question time. Stay tuned. Invest Wisely will be back after the break. Welcome back. I'm Leela Rao, your host for Invest Wisely, your ultimate gateway to prudent investing. Dr. Sompali in Florida has asked us an interesting question. How does chasing the winners affect your investment performance? Well, doctor, this is a very good question, and I have seen this in my vast professional experience haunting many investors. When the dot-coms were soaring high, people chased them, then the property market, and now gold and commodities. This will go on and on. Normally, people who chase the winners tend to do so after the investment has had a huge run-up. When the markets tend to correct, sending down these overpriced investments, these are the people who get very badly hurt. Actually, electronic trading has been a catalyst in encouraging this wrong practice. Simple rule of thumb is, buy the right thing at the right price. When a good investment is selling beyond its intrinsic value or the price it is actually worth, it becomes a bad investment for you. You keep chasing it and losing money not just on the investment but also on brokerage fees and taxes as well. Investment decisions should be taken after disciplined research and analysis and not led by emotion or impulse. We welcome you to write with your questions to the address you see on the screen. Until we meet again, remember, do not feel rich by earning money, but invest wisely to be truly wealthy. Thank you for watching the program.